How to diversify your portfolio with alternative investments. If your portfolio is 100% stocks and bonds, you could be missing out on some of the best opportunities available today. In this video, I'll show you how to diversify your portfolio with alternative investments and accelerate your wealth. Most investors only focus on traditional investments like stocks, but the wealthiest investors put a huge portion of their wealth in alternative investments. I'll show you why and how you can do the same. If you want higher returns, lower risk, and real protection against market crashes, then you need to look beyond traditional stocks. Stick with me and I'll show you exactly how to use alternative investments to build a balanced and stable portfolio. By the end of this video, you'll know exactly how to diversify your portfolio with alternative investments, why they outperform traditional asset classes in most cases, and how you can start investing in them today. So why does diversification with alternative investments matter to you? Traditional investment wisdom says just invest in stocks and bonds, but in this competitive investment environment, that's not enough today. Alternative investments provide higher returns. Many times they outperform the market. Lower correlation to market volatility. If the stock market goes down, that doesn't mean alternative investments go down. Alternatives don't move in sync with the stock market. Income and tax advantages. Real estate and private equity generate passive income and large tax benefits. So what's the ideal portfolio breakdown? Let's look at how the wealthiest investors invest. Institution and ultra wealthy investors are known to invest 30 to 60% of their overall portfolio in alternative investments. Examples of a diversified portfolio. Stocks and ETFs, 30 to 50% of the portfolio. Bonds and fixed income, 10 to 20%. Real estate, either owned direct or through private REITs, 15 to 25%. Private equity and venture capital, 10 to 20%. Commodities, including gold, oil, farmland, or crypto, 5 to 15%. Why do the wealthy do this? Well, alternative investments hedge against inflation and market downturns. What are the best alternative assets for portfolio diversification? Real estate. Myself, I like self-storage, mobile home communities, and industrial warehousing. They offer strong cash flows, long-term appreciation, and good tax benefits upon the acquisition. Private equity and business roll-up strategies. This is where private equity firms buy up home services businesses, medical providers. These business acquisitions have a high growth potential for long-term value creation. Private credit and debt instruments. These investments are stable and they're fixed income and they are secure against real assets. Gold, farmland, energy like oil or crypto. These hedge against inflation and they store value in down markets. Hedge funds and private lending. These have a low correlation to the stock market and high yields. At my firm, Patriot Holdings, we are a private equity firm that focuses on alternative commercial real estate asset purchases. So we look for assets that are highly fragmented, like self-storage, manufactured housing, and small bay warehouses. There's a large market of mom and pop owners that aren't maximizing the value of their businesses. So as in the fashion of true private equity, we go out and acquire these assets, put them in our management system, and then execute on the operational inefficiencies. We improve those inefficiencies by reducing cost and raising revenue through strong advertising and friendly, flexible management. Ultimately, we bundle the assets together, and this is what's a roll-up strategy is called. The combined value of all the assets in self-storage or in manufactured housing is a much greater value when sold at scale versus selling off one individual asset. This is how we drive accelerated returns and create value for our investors. How does real estate strengthen your portfolio as an alternative investment? Well, in my opinion, real estate is the alternative investment king. Here are the benefits. Real estate is a proven hedge against inflation, and the way that this country continues to print money, there will be lots of inflation. Cash flow, monthly rental income consistently comes in, creating distributions to the investor. Number 3, tax benefits. You get depreciation. These are passive losses that you can write off against passive income. Also 1031 and tax deferral strategies, so you can continue to push your tax liability down the line and be able to compound wealth in the meantime. Long-term appreciation. This is how inflation helps these assets. As rents go up, the value of these assets go up. Building materials get more expensive and the cost of construction continues to go up, so existing assets continue to go up with it. An excellent alternative investment asset class is mobile home communities. It is an alternative and not the traditional commercial real estate investment, and it solves the critical crisis of affordable housing in this country. And the beautiful part of this alternative asset is you don't own the homes, you own the land and the infrastructure, and then you lease out each pad to a mobile home owner. And nowadays, these mobile homes are not very mobile, so you have leverage to be able to charge rents, and these tenants will stay there. They do not have a lot of high turnover, and in turn, they pay rent, and you can drive high margins of profitability. This is a great example of an alternative commercial real estate investment. How private equity and private credit create wealth. Private equity firms invest in businesses, buying out smaller businesses and then bundling them together as we do in real estate. That way they aggregate to a larger scalable company that they can then sell at a higher multiple. Through operational efficiencies, they're able to lower the cost of operating the assets and bring them under one large company umbrella. This is what accelerates the multiple return for the investors due to this roll-up strategy. Private credit investments are getting popular, and they are where private funds lend to businesses, consumer, and residential customers. Private credit is attractive right now because it's collateralized against a real asset, and these funds are dedicated to lending. Typically, it's lower leverage, less than 70%, so the investors have a secure position on the asset and they get a guaranteed 8, 9, 10, 11, 12% return based on the interest they charge to the borrower. These assets focus on fixed returns versus stock market volatility. They also provide passive income through the interest payments that are being made by the borrowers. And these types of investments have higher yields than traditional fixed bonds. How to start investing in alternative investments. Decide what percentage of your portfolio you want to allocate to alternative investments. A good start is between 10 and 30% of your overall wealth. Choose asset classes that align with your financial goals. Is it cash flow? Is it appreciation? Is it tax benefits? Is it long-term wealth preservation? Step 3, find trusted investment managers, syndications, or fund managers. Patriot Fund 5 focuses on real estate. That is my fund. There's also private equity firms that focus on business roll-ups. There's commodity ETFs for inflation hedging, or there's other companies that focus on debt products for consumer or residential borrowers. Step 4, start small. Diversify across multiple asset classes and get a feel of the investment and the investment sponsor before you start to allocate to multiple alternative investments. So now that you know how to diversify your portfolio with alternative investments, the next step is learning how to evaluate private equity deals before you invest. Click on my next video so you can analyze private businesses or real estate deals just like a private equity pro.